At this point, you understand why book and taxable income differ, and you can classify any temporary differences. Now, we need to record income tax expense, income tax payable, and the deferred accounts that connect them. There are many approaches that would arrive at the same destination, but I'm going to teach this in a specific, methodical way that you'll hopefully be able to apply in any circumstances. The way tax accountants actually think about it. We're going to start with book income and reconcile our way to taxable income. By using reversing schedules for each temporary difference, we'll be able to keep the annual effects of our temporary differences straight, and the journal entry will fall right out of the reconciliation. Here's the destination. We need to record tax expense for financial reporting purposes, and we need to write a check to the IRS. While the tax return gives you one number, tax payable, the journal entry needs to give you three: tax expense, tax payable, and the change in deferred taxes. Where do the other numbers come from? They come from our reconciliation. A reconciliation is simply a schedule that shows how we get from one number to another. If you can walk from book income to taxable income and show your work, you have everything you need to build a journal entry. So first thing we do always is determine taxable income, starting from the number we already have, book income. The reconciliation logic is simple. We need to subtract anything that's been included in book income that hasn't been taxed yet, like revenue we've booked but the IRS is still waiting on. And we need to add back anything that's taxable now but hasn't been included in book income yet, like cash that we've received and the IRS taxed but we haven't earned it yet. Do the same on the expense side. Add back expenses that the IRS won't let us deduct yet, and subtract deductions that the IRS gives us early. What's left is taxable income. Simple to say, but here's where the students tend to get tangled. The signs. Which adjustments are positive and which are negative, especially 3 years into an item's life when differences are reversing. For that, I'm going to give you a tool that makes the signs automatic. I suggest you build one of these for every temporary difference in every problem that you work, the reversing schedule. Here's how it works. For each item that causes a temporary difference, build a little table. One column for each year that the item touches. 2 rows. The top row is taxable income. Here, include anything that is taxable or deductible that year, usually the cash effects. Then the next row is book income. In this one, same question, except is it earned or incurred? Is it included in book income or subtracted from book income? Then there's the sign convention. Everything that you include here that's deductions or an expense, make it negative. Income, make it positive. Then there's the payoff. Subtract the book row from the taxable income row, and you've got a difference row. That difference is the number that we need to plug into our reconciliation each year. The sign takes care of itself. A negative difference this year means taxable income is lower than book income by that amount. We need to subtract it from book income. And then notice what the row does over time. It flips the sign and sums to 0, originating differences in the first year and reversing differences in the other years. The schedule doesn't just give you this year's adjustment. It shows you the whole life of the difference, which is exactly what you need to know when each deferred tax will reverse. Once the reconciliation is built, everything gets multiplied by the tax rate. Taxable income times the tax rate is taxes payable. The credit straight to the IRS's line. Book income times the tax rate is tax expense. That's our debit, and it's matched to the income statement. Add each temporary difference times the tax rate, and that's the change in a deferred account. A difference that will make future taxable income higher is a DTL. One that will make future taxable income lower is a DTA. Current year difference negative, book higher now. Think DTL. Positive, taxable higher now. Think DTA. So the entry assembles itself. Debit income tax expense for book income times the rate. Credit income tax payable for taxable income times the rate. And the deferred accounts absorb the differences. Debit the DTAs you're creating, credit the DTLs. If you've done the reconciliation right, it balances every time. That's not luck. The deferred pieces are, by construction, the tax effect of the exact gap between your debit and credit. And don't stop at year 1. In a reversal year, the same schedule drives the entry in the opposite direction. The difference row flips the sign. So this year, you debit the DTL as it unwinds instead of credit, or credit the DTA as you cash in the future deduction that you recorded earlier. Deferred accounts grow when differences originate, and they shrink when they reverse. The reversing schedule shows you both halves on one row. One caution before we practice: deferred taxes are measured at the enacted rate for the year that the difference reverses. So when all years carry the same rate, you're not going to notice. But when rates differ, we need to apply those different rates for the future in the year that the originating difference occurs. So I'll show you that in an example. let tax expense be the balancing figure. In this example, we've got two temporary differences. One that results in an accrued expense, something that's recorded in book income today but isn't deductible until the future, and one that is an installment gain, so something that's recorded as a gain today but not recorded on the tax return until it's collected in cash down the road. So we're going to build reversing schedules for both of these and a reconciliation of book income to taxable income in order to build our journal entry this year and next. Let's start by building our reversing schedules for each of these temporary differences. I've already started here. Notice I've got tax first and book second, tax on the top row, book on the second row. So temporary difference number 1 is a $60,000 accrued expense. That means for book purposes, I have accrued an expense. I've debited expense, but I have not credited cash, which means I don't get a related tax deduction. So for book purposes, I'm going to show this as a negative $60,000 in year 1. That's the originating year of the temporary difference. And then for tax purposes, I have nothing in year 1, but in year 2, 3, and 4, I get a tax deduction. So I must have paid this expense in cash in these future years of 10, 20, and 30. Now, a reversing schedule, we just need to take tax minus book to give us the correct sign. 0 minus negative 60 is a positive 60,000. And then we have our negative items in the future years. We'll use these numbers in our reconciliation schedule only. That's the only purpose of the signs is for the reconciliation schedule. Now, reversing schedule for temporary difference number 2. We've got an installment gain of $45,000, which means for book purposes, we have recognized income of $45,000. However, we haven't yet collected that cash, so it is not taxable. It's going to be taxable in future years when we collect it evenly, $15,000 each year. So that is our reversing schedule, and our difference row is going to show a negative 45,000 because 0 minus 45,000 gives us a negative number, and then 15,000 positive for each of the future years. So notice that in these reversing schedules, the difference line should sum to 0. That's how you can check that you've done it correctly. Now in year 1, we need to create our reconciliation between book income and taxable income because we know what book income is. They've given us book income of $105,000, but we don't know what taxable income is. And that's the purpose of these reversing schedules, is to help us figure out what should we add and what should we subtract. Clearly for temporary difference number 1, because of our reversing schedule, we know we need to add $60,000. So plus temporary difference number 1, $60,000. That's because this was an accrued expense. We subtracted it to arrive at book income, but it is not tax deductible. So I need to add it back in order to figure out what my taxable income is. Then temporary difference number 2, our schedule tells us we need to subtract. So we'll subtract temporary difference number 2. And that's because this is a gain that was included in that book income of 105. However, it's not taxable yet, so we need to subtract it out. So that is going to give us our total taxable income of $120,000. And now we have everything we need to start building our journal entry. We just need to apply our tax rate of 25%. So we'll apply that to each line. And that will give us the numbers that will go into our journal entry. So first we've got $26,250. Then 25% times 60,000 is 15. And then 11,250, it's our negative item. Well, we don't really need to put the negative anymore. And then we have 30,000 here. So this is tax expense right here. And this is tax payable. But these two items in between are our deferred accounts. So the first one is a DTA. Temporary difference number 1 is a DTA. And that's because if you look at the reversing schedule, it's going to result in future deductions on our tax return. That's an asset to us today. Whereas temporary difference number 2 is going to result in future taxable amounts, which is a liability to us today, or a DTL. So now I have everything to build my journal entry. I simply need to debit tax expense, debit DTA, credit DTL, and credit tax payable for the numbers that you see here. Let's quickly look at year 2. I want you to assume in year 2 that book income is $200,000. So this is a new assumption not included in the original problem. And our reversing schedule is going to help us build the reconciliation for year 2 by showing us that we need to subtract $10,000 for temporary difference number 1. That means that we have a cash paid or a deduction on our tax return that we did not subtract when we prepared our income statement. And for temporary difference number 2, I need to add $15,000. When I add these together, I'm going to end up with my taxable income of $205,000. Then I simply need to apply my tax rate of 25% to each of these items in order to get my journal entry for the year. But I want you to pay attention to one thing here, and that is that although I'm calculating $50,000 for tax expense here, and I am calculating $10,000 times 25%, so $2,500, this is for my DTA. I want you to notice that this is the reversal of my DTA. This is a reversal. And I know because a DTA is typically positive, and I've got it shown negative here. And then 25% times 15,000 is 3,750. And that's the reversal of my DTL. So instead of debiting a DTA and crediting a DTL, I'm going to do the opposite. And then here I've got taxable income, and it is $51,250 for my tax payable. And so from this point, I can simply debit tax expense for $50,000. And I'm going to debit my DTL instead of credit. So I'm going to debit my DTL for $3,750. And I'm going to credit my DTA for $2,500. And credit tax payable for $51,250. So that's the journal entry in a reversing year. There's the originating year when the temporary differences arise, and the reversing year when we see that flip between book income and taxable income. Let's review. The whole goal of accounting for income taxes is to build the journal entry. To get there, we need to start by building a reconciliation between book income and taxable income. If we build a reversing schedule for each temporary difference now, we're going to be able to easily plug all the numbers we need into our reconciliation, this year and every year in the future. From there, we apply the tax rate to get each piece of our journal entry. Next, we need the items that never reverse at all, permanent differences, and we're going to see how they change the reconciliation.